Imagine this, you're walking along a tightrope. One wrong move and you could fall. Now, imagine if you had a safety net below you, something that catches you when things go wrong. That's what a diversified investment portfolio does for you. It protects your money from the unpredictable swings of the market so you can invest with confidence. Today, we'll show you how to build that safety net, giving you the tools to create a stable and prosperous future. Understanding diversification in the world of investing. Diversification is one of the most powerful strategies to reduce risk and increase your potential for returns. But what exactly does diversification mean? Simply put, it means spreading your investments across a variety of asset classes, such as stocks, bonds, real estate, and even commodities to protect yourself from the volatility of any one market. Think of it as not putting all your eggs in one basket. By doing so, you're less likely to suffer significant losses if one part of your portfolio underperforms. Step 1. Assessing your risk tolerance. Before you start building your portfolio, it's crucial to understand your own risk tolerance. This is how much risk you're willing to take on in pursuit of your investment goals. Are you someone who can sleep soundly through market ups and downs? Or do you prefer a more stable, lower risk approach? Your risk tolerance will influence the kinds of investments you choose and how much of each you hold. If you have a high tolerance for risk, you may lean towards more volatile assets, like stocks or cryptocurrency. On the other hand, if you're risk-averse, you might prefer safer options like bonds or dividend-paying stocks. Understanding where you fall on the risk spectrum is key to building a portfolio that works for you. Step 2. Allocating your assets. Once you have a good sense of your risk tolerance, it's time to allocate your assets. Asset allocation is the process of dividing your investments among different asset classes to balance risk and return. There's no one-size-fits-all approach, but here's a general idea of how you might want to allocate your investments based on your risk tolerance. For someone with a moderate risk tolerance, you might allocate 60% of your portfolio to stocks, 30% to bonds, and 10% to alternative investments, like real estate or commodities. If you're more risk-averse, you may choose a heavier allocation to bonds and cash equivalents, with less in stocks. Step 3. Diversifying within asset classes. Next, let's dive deeper into the diversification within each asset class. Just because you've chosen stocks doesn't mean all stocks are the same. You'll want to diversify your stock investments by sector, industry, and geography. For example, if you invest only in tech stocks, you're exposed to the risks of one industry. But by spreading your investments across different sectors like healthcare, energy, and finance, you'll be less vulnerable to downturns in any one sector. You can also diversify geographically, investing in international markets to reduce country-specific risks. Step 4. Including bonds and fixed income. Bonds and other fixed income securities can provide stability to your portfolio, especially when stock markets are volatile. While bonds generally offer lower returns than stocks, they tend to be less risky. A diversified portfolio includes a mix of government, corporate, and municipal bonds. Government bonds are usually the safest, but offer lower yields. Corporate bonds provide higher yields, but come with more risk. Municipal bonds are issued by local governments and may offer tax advantages. By holding a variety of bonds, you can cushion your portfolio against stock market fluctuations. Step 5. Adding real estate and alternative investments. Real estate can be an excellent way to diversify further. Real estate investments are less correlated with the stock market, meaning they often perform well when stocks are struggling. This can help stabilize your overall portfolio. You can invest in real estate directly by purchasing properties or through real estate investment trusts, REITs, which allow you to invest in property portfolios without owning physical buildings. Other alternative investments, such as commodities like gold or oil, and cryptocurrencies, can also help protect your portfolio from inflation and market volatility. Step 6. Rebalancing your portfolio. Your portfolio is not a set-it-and-forget-it kind of investment. As the market fluctuates, the value of your asset classes may change, causing your initial allocation to become unbalanced. This is where rebalancing comes in. Rebalancing involves adjusting your portfolio periodically to bring it back in line with your desired allocation. For example, if stocks have performed well and now make up a larger portion of your portfolio than you intended, you may sell some stocks and buy more bonds or real estate to restore balance. Regular rebalancing helps maintain the risk profile you're comfortable with. Step 7. Staying disciplined and long-term focused. Building a diversified portfolio is just the beginning. The key to success is staying disciplined and focused on the long term. It's easy to be swayed by market fluctuations, but it's important to stay true to your investment plan. Remember, the stock market will go up and down, and market crashes will happen. But a well-diversified portfolio will help you weather the storm and stay on course toward your financial goals. Creating a diversified investment portfolio isn't just about protecting your wealth, it's about making sure your money works for you, even in uncertain times. It's about peace of mind, knowing you're prepared for whatever the market throws your way. By following the steps we've outlined, you can build a portfolio that suits your needs, reduces risk, and maximizes your potential for long-term growth. It may take time, but the results will be worth it. Investing isn't a sprint, it's a marathon. Stay patient, stay focused, and remember, the best time to plant a tree was 20 years ago. The second best time is today. Thanks for joining us today. If you're ready to start building a diversified portfolio, remember, it's never too late to begin. With the right knowledge and approach, your financial future can be as stable and prosperous as you want it to be. Subscribe for more investment tips and strategies.